Hello everyone. Welcome to Demand Supply Trading Practical Session number 7 for the year 2026. Myself Rajit Kakkar, and today is Sunday, 1st of March 2026. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure. I'll keep it on the screen for some time, and do ensure that you go through the disclosure. All right, so let's keep it on the screen for some time, and then we have this page number 2. Perfect. So now we do have a channel on Telegram where we keep updating you with the content related to demand supply trading methodology. Plus the schedule of these live sessions are also posted there. So in case you want to be in the loop and get informed whenever these sessions are scheduled, you can join the Telegram channel. Now, how can you join it? There are a few different ways. The first way is you can see that you have the QR code on your screen. You can scan this QR code and you can join the channel. Second, if you go to the description of this video, you will be able to find the direct link. You can use the direct link to join the channel. And thirdly, when you visit our website, which is surjitkakkar.com, or you can use the short URL that is sk.coach. So whenever you visit our website, you can just scroll down on any of the pages to the footer section. And here you can see in the footer section, you have join Telegram channel banner available to you. And in front of it, you have the join now button. You can click on this button and you can be part of the Telegram channel. All right, so let's move forward. Now, talking about today's session is all about practical application of demand supply trading methodology. And today's session is going to be very, very unique. In fact, if you have been constantly attending my sessions, let's say even for the last 2.5 years, you will still see that today's session is going to be very, very different. Why it is going to be different, we'll talk about it as we move forward. But like I said, today's session is all about practical application of demand supply methodology. So our demand supply course is now available as a 100% free course. And when you go through the course, you basically learn the methodology theoretically. So how to apply it practically, that is what we do in these sessions. Now, how can you access the course? We'll also talk about it as we move forward in the session. But the best part about these sessions is you get two advantages. Advantage number one, whatever analysis we are doing in these sessions, we are not analyzing moves which have already happened, right? That is what you will generally see in most of the sessions on YouTube, that people are generally analyzing the moves which have already happened. But with demand supply methodology, we can always pre-plan our trades. So what you will see in these sessions is that we are planning our trades in advance. So you also don't know what is going to happen in the future. I also don't know what is going to happen in the future. So the sessions cannot be more transparent than this. And since we are doing the analysis in advance, does not mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them. And that helps you see both the before as well as the after. And since you can see both the before as well as the after, you start building up confidence in the methodology. And the second advantage is because this is a live practical session. If you have any questions, queries related to demand supply methodology, or even generic questions, queries related to trading, you can always put it in the chat box. And at the end of the session, I try to answer all the questions, queries that I get. So that's another advantage of the practical sessions. Now, to be comfortable with these sessions, there are some prerequisites, and completing these prerequisites will make these sessions much more easier on you. So let's talk about what these prerequisites are. So the very first one is the Trading Essentials course, optional for people who already have a very good trading background. If they want to skip it, yes, they can. Though I would recommend, irrespective what your trading background is, always start with the Trading Essentials course. Now, how can you access the Trading Essentials course? Very simple. Once you're on our website, under services, you have the option for the courses. Click on it. And here you can see the very first one is Trading Essentials. Click on Trading Essentials. The course is available in 2 languages, English and Hindi. So whatever language you're comfortable with, you can click on that button and you'll get immediate access to the course content as a playlist. No sign up required, no registration required. You simply click on the button, you have access to the course content, go through all the lessons. And once you complete all the lessons, that basically covers your Trading Essentials course. Now, once you are done with the Trading Essentials, the next step is to learn demand supply trading methodology, which you can do by accessing our demand supply trading course. Now, how can you access the demand supply course? Again, very simple. Under services, go to courses, and you can see the next one is demand supply trading. Click on get started. And here also you can see you have the course available in 2 languages, English and Hindi. So again, no registration, no sign up required. You just click on the button, you get immediate access to the course content. go through all the lessons, and once you cover all the lessons, you basically complete demand supply methodology theoretically. Now, once you have completed it theoretically, you also need to see some practical examples, because once you start seeing practical application, you get better understanding of how the methodology has to be applied, and that is where these practical sessions come in handy. So almost every other weekend I do a practical session, and we also keep the recordings of these practical sessions for you. So if you want to watch the recordings of the previous session, you can click on practical sessions here, and the practical sessions are also available in both languages, English and Hindi. So whatever language you're comfortable with, click on that and you'll get access to the recording of the previous sessions that I've done. And currently the archive is over 2 years of recordings that are available to you. So you have a lot of content available. The more number of sessions you will see, the better you'll start having the understanding of the methodology. So that's your first two prerequisites, which is the trading essentials and the demand supply trading course. Now, during the practical session, you will see that I use two documents. One is the rule book, the other one is the flow chart. And these two documents, they help us plan trades very mechanically and rule based. So how can you download these two documents? Again, very simple. On our website under services, go to downloads. And here you can see the first one is the rule book. The second one is the flow chart. So this is your rule book. We'll be using it while we do the analysis today, and this is the flow chart. So we'll also talk about it as we move forward. Just give me a second, please, because I'm getting some alerts, but the volume is pretty loud. Let me just fix it a little bit so that it's not very loud, and we'll talk about alerts as we move forward in the session as well. All right. So again, how do we use these two documents? You will experience it today during the practical session. But before we get started with our analysis for today, we do have two trades which were getting carried forward for us. We reviewed them the last session as well. So let's again start with the review of them. And once we are done with the review, then we'll start our analysis for today. All right. So starting with the review, this is the first one. Now this trade we planned on the 3rd of May 2025. This was session number 8 for the year 2025, and the prices came into the zone on the 21st of January 2026. Prices have just been hovering around the zone for the last few sessions, but there are few things which you'll have to see. The first one is for the target, we always use all demand supply structures. So initially we did not have any fresh area. Our fresh area was pretty far away, which was showing us more than 2:1. But what happened is during the last week, we had a formation of this base drop supply, right? So we had a formation of a new zone. So your reward to risk ratio basically spoiled because of this newly formed supply. But since we were trading at the best location, so at best location, what can be done is that if you don't have a good reward to risk ratio on your lower time frame, you can always double check it on your intermediate time frame. And in this case, you can see even on the intermediate time frame, last week we had formation of this supply area. So in both the cases, be that the lower time frame or the higher time frame, your reward to risk ratio has spoiled. So the best thing you could have done is you could have put your target here, which is almost at your break-even point. So you can see even though the prices, they went deeper, after the zone was formed, you could have got your exit. In fact, if you look at this, this is the day the zone was formed. So even if you placed your order somewhere around here, the very next day, because we gapped up, you could have got a small little profit on this. But basically now this would be a closed trade. You can call it as break even or maybe small little profit because of this gap up which happened the very next day. So we will be closing this and will not be carry forwarding this one anymore, because the reward to risk ratio has spoiled and you should have exited where you could have got a small little profit on this. So that takes care of the first one, which was getting carried forward for us. The second example which was getting carried forward for us was this one. Now this is session number 5 for the year 2026. We did the analysis on the 8th of Feb and the prices came into the zone on the 10th of Feb. So the last time also when we did the review, we talked about that our target can be somewhere around here, which is about a 6:1. Plus when we did the analysis, I also made some modification to the zone. If you would have not made this modification, your reward to risk ratio could have even been better, but that completely depends from trader to trader. And last time I also talked about that, yes, we have a formation of a demand area. So if you want to trail your stop loss somewhere around here, this can be done. In fact, now you have a formation of a new zone. So if you want to further trail it, now generally we start trailing it after the violation of supply, but let's assume you want to be a little aggressive, you still want to lock in some profits. This is where your trailing stop loss can be, which can still give you small little profit. So the worst case scenario is if the prices they come back, you still get a small little profit. But if they continue in your favor, then you have a reward to risk ratio that is approximately 6:1. For that, we can keep trailing onto it. So we'll keep it as an open trade. We'll track it for the next few sessions to see how this one plays out. And again, this has not been planned after this move has happened. If you go back and watch the recording of session number 5, you will see when we did the analysis, the chart was probably something like this. And then you can see that in one single day, we dropped around, I guess this was a 9.25% drop from the high to the low. Can you see we dropped around 9.25%? We came into our zone, and that is where we started moving up from. So you can see we've already had a move which is approximately a 3:1 move, but again the target is about 6:1. We can keep trailing onto it for a 6:1, and that's your example from session number 5, which is getting carried forward for us. All right, now let's get started with our today's example. Just give me a minute. Let me bring up today's example. So today is session number 7. Just a second. All right, so just a minute. So like I was talking about, that today's session is going to be very, very different from all the other sessions that I've taken in the past. And yes, if you have paid a little bit attention on the chart, probably you can guess what is the difference. The difference is that today we are planning a WIT trade. That's the very first time. And as we move forward with the analysis, you will also see it's not just a WIT trade, it's also a short trade. So generally you would have seen me only planning MIT trades, only planning long trades. But I have been getting this feedback from you people that if I can also share some examples of short trades, I can share examples of different purposes of trade. So I thought, why not to take a different example today, because that's the number one feedback which I have been getting from you people. So again, today we will be looking at a WIT setup, and it will also be a short trade. But what you will realize once you go through the analysis is that nothing changes other than the time frame, right? So demand supply, like I always say, it's a universal methodology. It can be applied to any markets, any style of trading. The rules, they do not change. The process does not change, even if you're changing the markets or even if you're changing your purpose of trade. The only thing that will change is your time frame, and that is the only modification that needs to be done if you're changing your purpose of trade, let's say from an MIT to a to an HIT or a DIT or a WIT. All right, so since I will be doing a WIT analysis today, so the first thing is I'll be changing my settings in the indicator. So now my higher time frame as a WIT trader would be weekly. My intermediate will be daily. And the refining time frame will be the 15 minutes chart, right? So I have done my modifications, and let's go to the higher time. In fact, let's go to the lower time frame now, which is 60 minutes chart. Perfect. So let's get started. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. If you have still not watched that video, do watch it. Very, very important. And the process that I've explained in that video, everyone will have to go through that process. The sooner you start, the better it is going to be for your trades. So since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, the challenge is when you start learning trading or when you start learning a new methodology, it's not easy to create a trade plan from day one. And the reason for that is that to create a trade plan, you need to have a good enough understanding of that methodology. You need to have a lot of experience, and only then you can create it, you can convert it into a rule-based system. So I know since this is a challenge, what I've done is I have created a ready-made trade plan for you, which is a conservative approach. With time, with experience, yes, you can definitely modify it to make it better suit with your personality style. But this trade plan is basically a combination of two documents. The first one is your trade plan steps. You can call it as the flow chart or the walkthrough. And the second one is the rule book. Now, minded, this rule book, like already said, is a conservative approach. With time, with experience, you can definitely modify it to make it more in sync with your personality style. So what is my step number one whenever we start planning our trade? The very first step is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So again, by exit, we do not mean just profit exit. Exit can be any kind. It can be in profit, it can be break even, it can also be in loss, it can also be your target as well. So yes, step one is I need to define my trade purpose. Now, why are we doing this? The reason is, just give me a second. Just a second, please. Right, so the reason is whenever we do our analysis, the charts that we use, they are time-based charts and we have a number of time frames available to us. So the very first challenge we face when we do our analysis is that there are so many time frames available. So are these a number of time frames? Which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We go with a very mechanical and logical approach. And that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so let's take example of NSE India, which is not a 24-hour markets. So whenever you're trading a market which is not a 24-hour market, I'm pretty sure you people would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24-hour market, we have that added gap risk involved in that particular setup. So this is why my recommendation to all of you is that initially your hourly dailies will be strictly intraday trades. You will not keep them as overnight trades and take unnecessary overnight gap risk. But when it comes to weeklies and monthlies, we have no choice because this is where we're not expecting to get the exit the same day. This is where we are, excuse me, we are anticipating that these trades can last for a few weeks or maybe even few months. So here we have no choice. We'll have to keep these positions as overnight positions, but that does not mean that for weekly monthlies we cannot have a gap against us. It can still happen, but since you're leaning against some bigger time frames, the probability definitely reduces, right? So again, my step number 1 is I need to define my trade purpose, and let's assume I opted I want to plan weekly income trade. So again, I'll add initially hourly, daily, strictly intraday trade, weekly, monthly is overnight, but with time, with experience, if you want to include daily incomes into overnight trades, that can be done, but don't do that initially. So here, let's assume this time I selected I want to plan weekly income trades. Now, as soon as I selected my purpose of trade, what is going to happen? From the rule book, now I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, a different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I selected I want to plan weekly income trades. So now I know as a weekly income trader, my time frames will be weekly, daily, 60 and 15. Weekly is the higher time frame which is used for curve analysis. Daily is the intermediate used for trend analysis. Lower time frame is 60. That is where we get our SCTS from. SCTS stands for stop loss entry target in size. And in case we need to use the refining time frame, then my refining time frame will be the 15 minutes chart. So can you see, as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using. In this case, weekly, daily, 60 and 15. Plus what is going to be the purpose of each and every time frame. I have the clarity to it. So my challenge number one is taken care. Now the next challenge is, yes, I do know my time frames, but if we again take the example of NSE, on NSE we have over 2000 companies listed. So it's not humanly possible that every day I sit and analyze 2000 companies to identify my opportunities. So what we need to do now is we need to have a process in place for selecting some scripts, right? From a big list, we want to get a small list so that I can do my analysis almost every other day. Now, how do we do this? For this, we use certain computer programs which are called as scanners or screeners. Now, the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then whatever symbols are matching with those conditions, the screener or the scanner will shortlist and give you the list of symbols. Now, if you do a Google search, you will be able to find a number of websites where you can create your free scanner screeners, which is based on conventional technical analysis or fundamental analysis. But the challenge is there was no scanner screener available based on demand supply trading methodology. So this is where I have created 2 custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. And these 2 tools purely help us shortlist symbols based on demand supply trading methodology. Now, if you want to understand more about them in depth, we do have the walkthrough videos available on our website. Now, how can you access the walkthrough videos? Very simple. Once you are on our website, you can go to services, click on trading view indicators. And here you can see you have the alerts and screener. Click on subscribe now. It will take you to the product page, and on the product page, the walkthrough videos are available, but I'll give you a brief understanding of how these tools, they basically work. So let's start with the alerts first. So here you can see I have got some alerts. So what alerts basically does, so the very first thing you need to remember is, first and foremost, alerts, they only work during live market. If the market is closed, the alerts will not work, and currently only the crypto market is live. So that is why I'm showing you example of alerts on the crypto market. So what I've done is, you can see in the alerts setting, I have given a list of about 20 symbols, and currently I'm on the 5 minutes chart. So what I'm basically telling the alerts alert system is that these are the 20 symbols I want you to monitor, and out of these 20 symbols on the 5-minute chart, as soon as you have a formation of a demand zone or a supply zone during the live market, update me, right? That is what alerts, they do, that during the live market, as soon as you have a demand or supply formation, it will update you. Now, how will you get the update? This will depend upon whether you have a free account with TradingView or whether you have a paid account with TradingView. Now, irrespective whether you have a free account or a paid account, you will get a table on the chart which will keep updating based on the time frame you're on. So if you're on a 5 minutes chart, it will update every 5 minutes, showing you the formation of zones on the 5 minutes chart. If I go to 15 minutes chart, it will update every 15 minutes and show you the formation of demand supply zones on the 15 minutes chart. So again, as a person who has a free account, only as a table you will be able to see it. But if you have a paid account, along with the table, you can also place your alerts, and you saw that we were getting some alerts, and you can also see the log of these alerts right here. And now, how do you get these alerts? That's completely your settings, whether you want it as a toast notification, you want it on your email. So whatever options TradingView provides you, based on those options, you can get your alerts. Now, just as an example, you can see here, okay, so the 5 minutes are up, probably. So as of now, we don't have any formation of demand supply areas. So what we'll do is, if we get some alerts, I'll show you example of how alerts, they basically work. So currently we don't have any formation of demand or supply area. So in fact, what I can do is, maybe I can take the last alert. On last alert, we have ETH USD and a rally based drop. ETH USD, let's go to crypto. So it said we have a rally based drop. So can you see, this was the last alert. We had a formation of a rally based drop. So this is how alerts, they basically work, that during the live market, as soon as you'll have a demand zone or a supply zone formation, it will update you. Perfect. So that's your alerts. The other one is your screener, right? So now let me also show you example of screener. Now, how does screener basically works? So just like alerts, in the screener, you can provide your list of symbols. Here you can give a list of up to 15 symbols. And for the screener, it is not required that the market has to be live. The screener will work irrespective whether the market is live or the market is closed. But there is a difference between how the screener works. Now in screener also I've provided my list of symbols. Now in this case 15 symbols. And then I have given my proximity setting as 2%. So what I'm telling the screener is that out of these 15 symbols, on whichever symbol the current candle is within 2%, to a demand area or a supply area, shortlist for me. And can you see it is telling me that we have Bajaj Finance, which is closer to the demand. So if I go to Bajaj Finance, you will see that we'll have a demand area and the current candle is close to this area of demand. And similarly, if I go to HCL Tech, we will be closer to supply. You can see we have a supply zone. The current candle is close to the supply zone. So that is how these tools they work. So again, alerts, they help you identify symbols where you have formation of a demand area or a supply area during the live market. And screener helps you shortlist symbols where the current candle is getting closer to a demand area or a supply area. Now, how close, that you can define based on your preference. So now you have a broad understanding of how these tools they basically work. But like I already told you, if you want to have more in-depth understanding, you can go through the walkthrough videos which are available on the product page. So again, your second step is to get a small list of symbols. Now, how do you get that small list of symbols? That's completely your choice. You can use the free scanner screeners, which are based on conventional or fundamental analysis. You can use these two tools if you wish to. You can make your process as simple as that. Maybe I have my own favorite list of symbols and those are the only symbols I want to analyze every day. Or maybe you can say, okay, I just want to analyze all the symbols which are in the Nifty 50 index. So choice is yours how you want to get that small list. In fact, I just got an alert. So let me quickly show you example of alert. Can you see now we have formation of demand supply zones on all these symbols. And as soon as it happened, we got the notification. So if I go to BTC USDT, let's go to crypto. I'll just take one example. You will see we'll have a drop base drop. Can you see as soon as this drop base drop was formed, we immediately got the notification. So this is how alerts they basically work. All right, so let's get back. So again, choice is yours how you want to get that list. But always remember, irrespective what method or what scanner screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols. Those scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list. Once you have that list, you will have to analyze them manually one by one and identify the one which matches with your trade plan. The one which matches with your trade plan might be an opportunity for you. The ones which do not match with your trade plan, anyhow, they have no meaning for you. So again, whatever your process is, get your list, and let's assume in that list, the very first one was ABC. So what am I supposed to do next? On ABC, I need to go to the lower time frame. So now the question is, what is my lower time frame? We got the answer from our step number 1, that as a weekly income trader, my lower time frame will be 60. So I'll go to the 60 minutes chart, and on 60 minutes chart, I need to identify a zone. And by zone, we mean any of these 4 structures. Now, identifying zones in itself is a challenge. So to overcome this challenge, we have also created an indicator which automatically plots demand supply zones on the chart. And we call it as the demand supply zone indicator, which is only available on TradingView. Now, we also provide a 7 days free trial of this indicator. So if you've still not taken the 7 days free trial, you can do that from our website. Now, how can you get the 7 days free trial? Very simple. Once you're on our website, under services, go to TradingView indicators. You can see the very first one is demand supply zone indicator. And on this page, you'll be able to find the 7-day free trial button. And it's a very small short form, which will take you less than 30 seconds. So you have to provide your full name. Then you have to provide your TradingView username. Now, very, very important. This is where you need to be extra careful that you're providing your TradingView username, because if you provide an incorrect TradingView username, it will not get activated for you. It will get activated for the person to whom that username belongs. Now, in case you don't have an account on TradingView, you can click here and you can create a free TradingView account, because this indicator works on a free account as well. And if you already have a TradingView account, you can click here and you can visit your profile, identify your TradingView username, fill your TradingView username here, your email address, on which date your trial will expire. You will also get to know about it. How did you hear about us? You can use the relevant option here and then click on I'm not a robot, and also go through the legal disclaimer, terms and conditions and privacy policy. If you agree to them, then check mark I agree, I read and I agree, and then click on finish and start my free trial. Now, once you fill this form, within 24 hours, the indicator will get activated for you, and once it gets activated, you will get a notification on TradingView itself that now you have access to the indicator, and then you can try it for free for 7 days. All right, now since everyone has the option that you can try this indicator for free for 7 days, all the analysis we will be doing will be using the indicator, so that you can see the beauty of the indicator. You can see how easily it makes the how easy it makes the process for you. So next step is we need to go to the lower time frame and identify zone. So you can see on the lower time frame, I have already marked my I've already applied the indicator and it is identifying my demand and supply areas. So can you see if I zoom out, this is where I have my demand areas, this is where I have my supply areas. So from the current market price, you can see the nearest supply zone is this, which is a drop-based drop. So yes, we have identified a zone. So what I'll do is I'll draw this zone, which is a supply area for us. Perfect. So yes, step number 3 was to identify a zone. Do we have a zone available? The answer is yes, we do have a zone available. Now, once we have identified the zone, does not mean that we blindly trade it. The next step is we need to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the very first condition we'll check is that can the zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is why level on top of level is the very first criteria we'll look into. Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, there is a possibility that it might be a case of level on top of level. But if you don't have a coinciding level, it can never be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And in this case, my intermediate is daily, right? So you can see on the daily, we do have this rally-based drop structure available to us. So what I'll do is I'll mark this rally-based drop, but this time with a different color so that we can differentiate between the two. So the one in green is my intermediate time frame zone, and the one in pink is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, it is definitely inside of it. Now, to be a case of level on top of level, it is not mandatory that all the zones might be quality zones. So what I'll do is I'll change the settings to all demand supply structures. And now you can see that inside of this, we don't have just one zone, we have 3 different supply areas. So this is the first one we marked. Then we have this drop-based drop, which is the second one. And then we have this rally-based drop, which is the third one. So you can see we have 3 zones inside of it. And again, the concept which I was talking about, we can see exactly the same thing, that you have your intermediate time frame zone, which is now getting divided into 1, 2, and 3 zones on the intermediate time frame zone. And whenever we have such a scenario, what do? We call it as a case of level on top of level. So we know that this is a case of level on top of level. And what we should be doing in such a case, we should be leaning against the highest zone, which is right here. So what I'll do is that even though we started with the lowest one, but since now it has proven to be a case of level on top of level, we will go to this highest zone, which is right here. So that's the modification we will make. So that's your supply. So yes, it was a case of level on top of level. Based on that, whatever modification was required, we have made that modification. Now, is this zone because of a gap? The answer is no. Is it a pivot or non-authentic zone? The answer is yes, because you can see that we have a rally-based drop structure, and rally-based drop we always consider as a pivot or a non-authentic zone. But do we need to apply the pivot non-authentic rules? The answer is no. And the reason for that is if you look into the rule book, in the rule book, we have a rule which says that in case of level on top of level, in case of level on top of level, there is no need to apply the pivot or non-authentic rules, because the positive factor we are looking for, we already have that being a case of level on top of level, right? So yes, we can skip the rules of pivot and non-authenticity in this case because it's a case of level on top of level. And Unstable equilibrium. Now in this case, you can definitely see, if I just hide the indicator, that the leg out is going above the basing. But since again it is a case of pivot or non-authentic zone, if you want to skip it, we can definitely skip it. But what I can also do is I can go to my refining time frame, which in this case would be the 15 minutes chart, to see do we have a drop base drop structure inside of it, which is missing in this case. So what I'll say is that since it is a case of level on top of level, if you want to skip pivot and unstable equilibrium as well, that can be done. But let's assume if you're a very conservative trader, in such a scenario, this might not be a tradable opportunity for you, right? So again, if you're being very conservative, this is not an opportunity for you. But if you're a little aggressive, because it is a case of level on top of level, I'm still okay with this, right? So what I'll do is now I'll hide all demand supply structures, because I only want the chart to show quality, and then I'll draw my entry stop losses and start from here. This is my proximal, distal, back to the proximal. So yes, we have looked into these conditions. Level on top of level was applicable. We made the modifications based on that. Gap is not applicable. Pivot not authentic as an exception, not applicable. And unstable equilibrium also as an exception, being a case of level on top of level, I'm skipping it. But yes, if you want to be extra conservative, then based on unstable equilibrium, this will get disqualified for you. So after applying the applicable rules, is the zone qualified? The answer is yes. And since I have a qualified zone, the next step I will do now is do the booster scoring. So let's apply the boosters. So the very first one is freshness, and you might say that if I bring up the chart again, or the zone again, that the zone has already been tested and it has been tested pretty deep, right? So you might say, let's give it a score of 0 for freshness. Strength, this is not an explosive move, otherwise the indicator would have marked it even when we were not using all zones. So it is not an explosive move, gets a score of 0. Time at the zone, we only have one candle, gets a score of 2, and reward to risk ratio will take it as an assumption. So the question now would be, why are we using a low quality zone? And the answer again is in the rule book. So here you can see the rule book says that there are certain characteristics to level on top of level. The first characteristic is that in case of supply, the upper zone might be tested by the lower zone, and that is what you can see here, that the upper zone was formed, it got tested, and then the lower zone was formed, right? So that's one of the characteristic of cases of level on top of level. Second characteristic is that in case of supply, the upper zone might be lesser strength versus the upper zone versus the lower zone. That is what we can see, that the zone that we started from had an amazing strength, but the one which we landed up to, it is not showing us very good strength. But that is again one of the characteristic of cases of level on top of level. And the third one is that in case of supply, the upper zone might have more candles versus the lower zone. That is not happening in this case, but that can also happen at times. So always remember that these characteristics which are there for cases of level on top of level, it's not that they'll always apply, right? They might apply, they might not apply. Some of them might apply, maybe none of them might apply. So these are some of the characteristics which you might see at times. So what we need to understand is that level on top of level basically implies that I'm trading the intermediate time frame zone by fine tuning it on the lower time frame. So what we are doing here is, if you think about it logically, this is my intermediate time frame zone, which is a rally based drop. Now, if I wanted to trade this rally based drop, this is where my proximal will be, this is where my distal will be, and the zone will be this wide. But since this zone got converted into multiple zones, I'm just trying to fine tune my entry and get a deeper entry inside of the zone. So that is what we are doing here. So that is why the rule says that if you see the above set characteristics, you can ignore those characteristics and you can do the rating of the zone based on the intermediate time frame. Now always remember, whenever you're doing this now based on the intermediate time frame, whichever boosters they already have the highest score, you're not going to touch them. The ones which do not have a highest score, we will see can we make the score a little better. So like here, if you talk about freshness, you can see after leaving the zone, price has never been back to the zone. So for freshness, we'll give it a score of 3. And here we do have a follow through pattern for which I can give it a score of 1. So if you look at the overall scoring now, from a low quality zone, it got converted into a high quality zone based on this rule that we had in the rule book, which is certain characteristics of cases of level on top of level. All right, so now that we have done the scoring for the quality, let's do the scoring for the probability, right? So let's start with the probability boosters now. So the very first one is location. You can see, oh, sorry, we need to go to the weekly. We are planning our trade very high in the curve, which is the best location to plan a short trade. So it gets a score of 2. Now at best location, trends, they become irrelevant, doesn't matter up, down or sideways. All kind of trends will be a score of 1. So we can even skip the analysis for the trend, but you can see that if you apply, it is showing you that we are in a sideways trend. So the indicator also helps you identify trends based on zone violation. So that's your trend. Moving on, to move from the zone, we need at least a 3:1 move, because I'm planning for a 2:1, and you can see we already have a move which is probably a 5:1 or a 6:1. So this gets a score of 2. Level on top of level, yes, we have already verified that. Coinciding, yes, because if it is not coinciding, it cannot be a case of level on top of level. And talking about trap, let's see that can this zone work like a trap. So what I'll do is I'll take horizontal lines. Oops, my bad. I'll take a horizontal. Just a second. All right. So let's take a horizontal line wherever my proximal is, and then we'll start pushing it down, trying to identify an area where prices have been bouncing over and over again. So if I start moving down, nothing great as such. Okay, so this area looks now a little better, somewhere around here. Can you see, if you look at this area, in the recent past, it has acted like support, right? Here it has acted like resistance, somewhat resistance. Here it has been acting like support. Here also it has been acting like support. So we do have a pretty decent area of support resistance, which is available right below our zone. So what is going to happen, people who believe in support resistance, this is where they will be buying, and their stop losses will be placed above, and those stop losses will be the sell orders. And similarly, if we get a breakout, people who believe in breakout will also start, sorry, my bad. So this will be resistance. So this is where people will be selling, right? My bad. People will be selling, and their stop losses will be buy orders. And similarly, if we get a breakout, then people who believe in breakout will also start buying. So by the time we enter into this area of supply, what is going to happen? We'll have a lot of buying coming into the market because of the stop losses, because of the breakout traders. And what these people are doing now is they are making two novice mistakes. Mistake number one, they are buying after an increase in price, which basically implies they are buying at an expensive price, and also buying in an area where the chart has proven to us that back in history, supply exceeded demand. So can you see I have been doing demand examples for the last X number of years. So by default, I'm going back to that, back to that analysis where, I'm always having demand at the back of my mind. So anyways, so this is where we have more supply, and that is what the chart has proven to us, which could be the only reason for prices to move down. So yes, the possibility is there that this might work like a trap, for which we will give it a score of 1. So if you look at the overall scoring, we have a high quality, high probability setup, and high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this is going to be a type 1 trade. Now what you can see today is, can you see the trade shifted from an MIT to a WIT, from a long to a short, but nothing changed. The process, the rules, everything remained the same, right? That's the beauty of demand and supply. So anyways, yes, we got to know that this is going to be a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll have to do our position size calculation. Whenever the prices are back, we'll have to re-verify to ensure that it still qualifies based on our trade plan, because the markets are not static, markets are dynamic, conditions are always changing every other second. So before entering a trade, we always re-verify, does it still qualify based on our trade plan? If the answer is yes, we place our order based on the entry type. And once your order has been executed, the last step is your trade management, where step 1 is at 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically and very rule-based. And if these sessions are helping you plan better trades, then do like the video. And I'm pretty sure that you people also understand that a lot of people are struggling with trading, and all my courses and these live sessions are 100% free. So do share the link to my courses, the link to these practical sessions to your fellow traders. So if you're part of some trading group or trading community, do share with them so that more and more people can take advantage of it, because these are all free resources available to everyone. And you never know, you might be helping somebody be a better trader eventually. All right, now, like I said, at the end of the session, I'll take your questions, queries. But before I do that, one more thing which I would like to add, that there is a feedback which we were getting from you people that yes, at the end of the session, you do take your questions, queries. You do take our questions, queries. But what if I don't want to ask my question publicly? Or what if, let's say, I want to share my charts and ask some questions based on my charts? So for that, we do have an option which is called as one-to-one appointment. So on our website, you can see on the top right corner, you have this one-to-one appointment option. From here, you can schedule an appointment. Two kinds of appointments are available. The first one is a voice call. So if you feel that on a voice call, you can get the answers to your questions, queries, you can go for a voice call. And the second one is an online meeting. So if you feel you want to share your screen, maybe you want to show something on your charts, then you can also go for an online meeting, right? So these two options are definitely available. But yes, if you're comfortable asking your questions during the YouTube live session, you always have that option that you can put your questions in the chat box, and I'll try to answer all the questions before we end the session. So for today's session, I don't see any questions in the chat box as of now. So that basically brings us to the end of today's session. Thank you everyone for joining in. Next, I'll be seeing you next weekend. Until then, trade safe. Enjoy your Sunday. Take care. Bye-bye.